Hello. So, the topic I'm going to discuss today is the difference between trade quality and portfolio risk. Firstly, there's a misconception that a profitable trading opportunity should be taken at all times. That seems reasonable. It's got positive expectancy, so why not? But risk management at a portfolio level is a bit more complicated. A good trade may actually be executed at the wrong time. For example, say a trader takes their trades individually. They may ask, will this trade make money? Does it fit my system? And does it have positive expectancy? Therefore, take the trade. However, portfolio level risk is different at the individual trade level. So, expanding on this, say you've identified three trades. Each one is attractive individually, they've got positive expectancy and they pass all your entry criteria. So you take all three trades, but they're all linked to one underlying market theme. This means they combine to form one concentrated risk profile. And an adverse event could simultaneously impact them all. This highlights the importance of structural analysis. So it's less about how good is this trade and more about how does this trade link to risk within the portfolio, because new positions change structure, exposure, and actually trade quality is not the only consideration, because professional risk management is less about individual trades and more about the interaction between the positions. For example, how correlated are the trades, how concentrated is the risk exposure, how much risk is deployed, and how vulnerable is the portfolio to a single market event. These questions matter more than the attractiveness of a new trade setup. This highlights that positive expectancy alone is not enough. Trade, a trade may be high quality, well researched, or statistically attractive, but increases the portfolio risk beyond an acceptable level. So, rejecting a trade may improve long term performance. This pushed me towards thinking more structurally about my own trading, not asking, will this trade work, but more about how does this trade interact with the portfolio, and identifying those relationships reveals invisible risk at the individual trade level. inconsistent performance is not directly linked to individual trades. It's about the interaction between expectancy, risk, exposure, and portfolio structure too. And identifying those relationships can actually be where the real diagnostics work starts. So, if you'd like to learn more about trade expectancy, structural analysis, and systematic trading performance, then I'll provide additional information in the description below. Thanks for watching today, and I'll see you in the next video.